In today's video, I'm going to be taking a serious look at different oil stocks between Canada and the United States to see, of course, is this really a good investment right now? Oil's going through the roof, so let's go check these out. The first one we are going to look at is Occidental Petroleum Corporation, OXY. Now, why is this one such an interesting one? Because Warren Buffett just invested a ton of money into it. It has very good volume. Discount, of course, the recent volume because of Warren Buffett. This looks really interesting because oil stocks are starting to have a comeback. Of course, there was that big drop, not just because of the virus, but also because there was so much oil at that point in time in the world that companies couldn't pay people to take it off their hands. So oil went negative. Gas was around like 78 to 80 cents a liter here in Canada. Now it's getting closer to $2. It just went up to $1.91 a liter today. So if you go $1.91 times 4.3, which is what it would be in gallons. Currently, we're paying, if we were Americans, 4.3, about $8.21 a gallon here in Canada. That is ridiculous, mostly because of taxes. But anyways, this is massive because now with the United States cutting back on oil as well as Canada because of the green deals that they're trying to do, that allows other countries like Russia to mine more oil and make more money. And now with the whole world not allowing any money to flow into Russia, this is why gas and oil prices are going through the roof. And that's why you're seeing this gradual increase until recently. This also tells me that this 1 cent dividend is probably going to change pretty soon as well. They lowered their dividend a couple of years ago, mainly because of that oil price. And now, with Warren Buffett investing when nobody is investing in this business, be fearful when others are greedy and be greedy when others are fearful. That is his motto, and that is where he's going. Where you have to remember that Bank of America also lowered their dividend to a penny many years ago, and Warren Buffett invested, and now we're seeing the same here. Overall, they've had 4 good quarters. Of course, 2020 was a painful year for pretty much any oil company, and since then they've had higher revenues than they did before the pandemic, and of course, not necessarily higher earnings, but at least positive earnings. Marathon Oil, MRO, is another fantastic company, and it's quite interesting. It's got a 1% dividend. It's got crazy volume, so it's easy to get in and out of. It's got a cheaper PE ratio than Occidental. Over the past 5 years, it's now hitting a 5-year high, so that is something that we need to not discount. Do we think that there could be a downturn? Well, the time of recording this video, there is a little bit of downward pressure on oil stocks and oil in general, but I'm not too sure how long that will last. There has been some pretty high volume going to the upside versus the volume that they had previous to the pandemic, so that is also a positive sign as well. But could that increased volume be just everyone thinking that that is the future as to what is going to be going on? And going back to the whole Warren Buffett idea of be fearful when others are greedy, could this be a time where you want to be fearful instead of greedy, as many of these investors are currently being? So also something to keep in mind. There are ways to play both sides though. Yes, they have been raising their dividend recently, but they have lowered it since 2014, 2015 when oil prices were again going through the roof. Isn't that kind of interesting how oil prices went down when a certain somebody came into office? However, 4 past beats when it comes to their quarterly earnings, and when it comes to their financials, they're not back up to what they were doing in 2018. However, their earnings are getting pretty close, and so is their revenue. Next is CNQ, a Canadian company, Canadian Natural Resources. This is also on the American stock market as well. This is paying a lot higher of a dividend. You're going to find that many Canadian oil companies are better at paying dividends than some of the American ones. Again, high volume too, which is really good, and much lower PE ratio. Keep in mind that with Canadian oil companies and the ones that are mining in Canada, yes, we are usually a much cleaner way of mining oil than pretty much anywhere else around the world. However, that comes at a price. It is a lot more expensive to mine for oil up here in Canada, and it takes a heck of a lot longer to get approved to do so. So there is a downfall to that. However, before the virus, the stock was trading sideways, and since then, it's gone on to pretty much close to all-time highs or well past all-time highs. They've also raised their dividend recently as well, which is very promising, and they never lowered their dividend either during that recent downturn. So that's another positive in my eyes. We've seen 4 beats as well in the last 4 quarters, and they only had a slight negative earnings versus what other companies were really burning during that time. And they've come back, and they have really done really well in 2021. Suncor is another great Canadian company that's got a 4% dividend, and SU on the stock market. Crazy volume once again. PE ratio is a little bit more expensive than CNQ, but still much cheaper than the American equivalents. They're not back to their 5-year high or anywhere close to their all-time high, so this is obviously an option if you were looking at potential gas prices and things like that. They also didn't exactly lower their dividend. They did temporarily during that downturn, but they really quickly brought it back, and many companies haven't done that. For those who did lower their dividends, many didn't bring them or haven't brought them back yet, so that is a positive. One negative, however, of this stock is, of course, Q4 was a miss versus Q2 was a meet. However, they did have 2 beats, one being very, very strong, and they haven't come back to past pre-pandemic highs, so there is that issue as well. However, there is a bright side, and that is, even though their revenues are pretty much what they were before the pandemic, they're also making more money after the pandemic too. So obviously 2020 was not great for any oil company. This is a way that you could play it even after the fact, and this is Enbridge. Enbridge is generally going to be trading within the same positive and negatives as oil. They do have a much higher dividend. This is a pipeline company, and they have high volume. Now, why Enbridge is actually a good play is because there's going to be oil being pumped anyways. And if the governments in Canada and the United States do start opening up more oil mines, then Enbridge will be able to potentially pump more gas, depending on what type of gas that they're mining in certain regions. However, this is also a future play as well, because Enbridge, unlike TransCanada is, of course, investing in green technology, but Enbridge, from what I've been reading, is investing more into things like solar panels and, of course, into wind power and even into power generation stations of different types. And to me, that is the future. We have to understand that oil is not going to be here forever. Yes, we could mine all of the oil in the United States and Canada for the next 100 years and produce enough oil to be able to basically feed the entire world for 100 years. But then we would be out. So we have well over 100 years worth of oil left in the ground still. However, we have to look to the future, because as we've seen with coal kind of went away and it's had its ups and downs recently, but oil is going to be the exact same. I understand that we're never going to get rid of plastics and things like that, but when we start looking at it, there's going to be more and more electric cars. We're going to need more and more electric infrastructure, and if there's a company that is providing that, like Enbridge, we can play both sides now. We can play that oil side, which is currently doing really well, but we're also going to be playing the future 20, 30, 40 year outside of the whole electric revolution in cars. I have a Mustang, 5-liter Mustang. I'm not against oil, believe me. Anyways, I hope that this video has helped you so far. However, let's really look at Enbridge's chart. And Enbridge's chart is high here, high here, high here. It's hit 3 highs. This is potentially a W, which could lead to a massive downside. But because it's over 5 years, this is something that generally, in my opinion, over that long distance is not going to affect the stock. I think that this could have a little bit more of a run going, especially for the next 20 to 30 years. they tend to increase their dividends quite often as well. Now, while they did have a Q4 miss, they did have 3 beats in a row. Their revenue is still not back to pre-pandemic. However, with potentially more mining happening in North America, this could have some pretty big upside. Again, I'm not against oil. I don't invest in oil companies other than Enbridge, but it's more of a pipeline company, so there is that. I do have a 5-liter Mustang, and I'm not going to get rid of that anytime soon. I don't care if gas prices go to $100 a liter. I'm not getting rid of my Mustang. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.